It's Sunday, December 13th. This is episode number 140. Saving $46,000 in tax this year, buying a loaded Tesla X. Facebook and YouTube live finance show. The show that teaches high earners like yourselves how to make your money work for you, so you don't have to pay. So you don't have to work for your money. We talk about general investing, taxes, real estate, Airbnb, syndications, paying for college, paying for childcare, and even the car you drive. So today is going to be part one of a mini series on taking big business deductions. This is also part of year-end tax planning. This question comes from Kathy C Squared in the Facebook group. Can you talk about very large things we can deduct for business, like cars, planes, or maybe vacation homes? Okay, so we are going to cover cars today, and this is a relatively big topic, and there's a lot of confusion about it because there's been a lot of changes in how cars are depreciated with the change in tax laws from before the Tax Cuts and Jobs Act to after the Tax Cuts and Jobs Act to late September of 2017. It's similar to what had happened in real estate with respect to the bonus depreciation changes. And just to kind of recap the real estate aspect, then we're going to take that to cars. Okay, so in real estate, they've had bonus depreciation. It's been a thing, but it hasn't applied to a lot of people because it had relatively strict requirements in real estate. For example, you had to be doing basically like a development, like has to be a brand new purchase in order to qualify for bonus depreciation. And bonus depreciation is often limited to like 50%. Which would mean like half of the value could depreciate up front, and the rest of it would be under a linear, or we call MACRS, or modified accelerated cost recovery system, where it would then go down over like a certain number of years afterward. But the Tax Cuts and Jobs Act came in and changed things. And then after September, I think 27th, 2017, after that point, the changes to bonus depreciation allowed you to not only did they increase depreciation up to 100%, but they also allowed used properties to qualify for bonus depreciation. So in the multifamily syndication space, when people bought properties a few years ago, they were buying them and they were doing cost segregation analyses, and that was basically it. You would depreciate the contents of the building that were on a 5-year scale. You would do that over 5 years. With bonus depreciation, you can take those 5-year things and depreciate it all in the first year, if it's 100% bonus depreciation. If it's 50% bonus depreciation, you could take half of it and then plus the 5-year method. Okay, so that 100% bonus depreciation really changed a lot of things because it increased that amount from like 50% to 100% in some situations, but it also allowed used properties that were already in service by somebody else. The next buyer can depreciate it again. Okay, so now looking at cars. Cars also got changed. Now, you can always just deduct like your standard mileage and a certain amount per mile. And that's a set flat amount that the IRS gives you, like 55 cents per mile or something like that. Okay, and that changes every year based on inflation. That didn't change. Okay, but depreciation changed, and Section 179, which is a special portion of the tax code, which is great to allow somebody to basically write something off entirely in 1 year. So it has a lot of things related to bonus depreciation, but it's a completely different section of the tax code. Section 179 allows you to take certain things and you could expense the entire thing or a certain amount in a given year higher than just taking a traditional linear or MACRS based depreciation. And it makes for accounting to be a little bit simpler because a lot of these small things that you don't want to be depreciating a bunch of small things. It's just a headache from a paperwork standpoint. Okay, but so before bonus depreciation was eligible for a lot of things, Section 179 was like this little holy grail from the tax code that made A, accounting a lot simpler, but B, allowed you to take a lot more losses up front. Okay, but most, like in my experience, I've used it for like buying a laptop or something like that. And it was something that I paid for in cash and then I deducted it. So it was money that was already out of my pocket. What gets interesting here is when you're doing it on really big items where you're not actually taking all that money out of your pocket right away. Okay, and when the depreciation schedules are changed so that you can also depreciate more, because there was a limit on how much you could just readily deduct for a car. So for example, there used to be a limit, okay, on luxury automobiles. $10,000 the first year you could write off, $16,000 the next year, $9,600 the third year, and then $5,760 for the subsequent year. So it would be limited each year. Okay, when Tax Cuts and Jobs Act came into play, they added first year bonus depreciation. And like in the first year, it increased it from 10,000 up to like 18,000 from one source I found. Okay, so that's nice. And across a total of 4 years, that's like $50,000 of depreciation. So that's actually a lot of depreciation for a lot of vehicles, but a lot of bigger vehicles these days cost over $50,000. Okay, now regular vehicles, okay, like under 6,000 pounds are also a special category, or whereas vehicles over 6,000 pounds were a special category. Okay, because if a vehicle is over 6,000 pounds of gross vehicle GVWR, gross vehicle weight something, forget what that R stands for. Somebody will let me know. But if it's over $6,000, 6,000 pounds empty, and this is like, it'll say it on a sticker on the inside of the door. It'll say what the GVWR is. If it's over 6,000 pounds, then this is a vehicle that is basically felt to be a utility vehicle for moving stuff or for business use, like a pickup truck, like a half-ton pickup truck, okay, or a big, huge van with no windows in the back and all for storage and moving stuff, okay? But it also interestingly applies to SUVs, which are passenger vehicles, okay? So you can take depreciation on any vehicle, okay? But the special situation where you have a 6,000 pound GVWR vehicle, there is no limit on how much you can depreciate it. And using 100% bonus depreciation, you can do that all in the first year, the first calendar year, which is absolutely crazy, but that's what it is. So first, there's always catches. It has to be something that is used more than 50% for business purposes, okay? And your depreciation is going to be proportional to the business use, okay? But it has to be over 50%. If you're under 50%, then you won't be able to qualify for bonus depreciation. You can do, I think, this like the regular linear depreciation based on personal use. But if you're using it more than 50% business use, and that has to be for the entire depreciation period that it otherwise would be. So I believe for like 6 years. If you didn't do bonus depreciation, the MACRS system requires a 6-year depreciation schedule. So for those 6 years, you have to have use more than 50% for business. But here's the catch. The proportion is based on the business use for each year as a separate year, okay? And we have 18 more days left in December. And so if you buy a vehicle and put it into business use by December 31st, then you can take advantage of this. So let's pretend you go to the dealership and you buy a vehicle over 6,000 pounds. Now, it doesn't have to be over 6,000 pounds, but if it's under 6,000 pounds, you're not going to be able to get that uncapped limit. If you want to get that uncapped amount, then it has to be over 6,000 pounds. And you have to put it into business use before the year is over. Now, you should also title the vehicle, from my understanding, to your business. And this has its own set of issues from a liability standpoint, which I'm not going to get into. Okay, but if your business owns the vehicle, then your business could be liable for an accident, okay, more so than if it was an individual. So something just to be cognizant of. But for tax purposes, if it's titled to the business, then it's clearly a business vehicle, and it'll be deducted on the business return, okay? And you have to put it into business use. So like if you just bought it and let's say you didn't even pick up the vehicle until January. Well, it's not actually into business use yet. You need to have the property put into business use, and that could be anything. And if you picked it up on December 31st and you used it just that one day for business use, and you used it to move something or for your business, or drive from point A to point B, that was just business use, then you can claim 100% business use for 2020. Then your bonus depreciation won't be decreased based on the personal use amount, because there won't be any personal use for 2020. So you get the full 100% bonus depreciation. Whereas if you bought the car, let's say earlier in the year, let's say you bought the car January 1st and your business use was 60% throughout the year, then you're only going to get 60% bonus depreciation, because you'd take the 100% bonus depreciation and multiply it by 60%, which is that proportion. So ideally, you want to use it 100% for business use this year and have it placed into business this year. Then you don't have to worry about that. Now, then the question is, well, what vehicles qualify that are over 6,000 pound gross vehicle weight rating, I think is what the R stands for. Okay, so there's a bunch. You can find different lists online, but remember, you have to check that actual vehicle for each one, because some of them are borderline, and depending on what options it has or doesn't have or whatever, it can be slightly above or slightly lower. You definitely want to make sure that sticker, that's the only thing that really matters, is what the sticker says. Okay, the IRS is not going to go and like weigh your car, but they could audit you to find out the VIN number of the vehicle and, look it up and it'll have that information. Okay. Or just send a picture of that sticker. So I'm just going to go in alphabetical order here from a list that I found. The Audi Q7 SUV, BMW X5, X5 Drive, X6M, X6 Drive, Buick Enclave, Cadillac Escalade, Cadillac XT5, XT6, got Chevy Silverado pickup truck, Suburban, Tahoe, Chevy Traverse. Interestingly, the Chrysler Pacifica hybrid and Pacifica are listed here, but minivans are like a different class, and this gets a little bit confusing. Pickup trucks and SUVs are different, but anyway, Chrysler Pacifica hybrid is over 6,000, as well as the Pacifica. Minivans are fantastic utility vehicles, and that's actually the reason why we have a Pacifica, is because we got one after our first kid was born, but the first kid was the excuse to get one. I wanted to have one before that because they are awesome for moving stuff. Dodge Durango, Ford Expedition, Explorer, F-150, Ford Flex, GMC Acadia, Sierra, Yukon, Honda Pilot, Odyssey, Infiniti, Grand Cherokee, Land Rover, Range Rover, Land Rover Discovery. Interesting, when you go to the Land Rover dealership, they have like all of these little advertisements about the Range Rover and the Discovery about the depreciation schedule. And this is before the bonus depreciation rules changed, because they just got over the 6,000 pound limit. And so you could very rapidly reduce the price. Lexus GX 460, Lexus LX 570, Lincoln MKT, Lincoln Navigator, Mercedes G550, G-Class, Metris, and Sprinter. Those vans are awesome. Nissan Armada, Ram ProMaster, Tesla X, Toyota 4Runner, Toyota Land Cruiser, Toyota Sequoia, Toyota Tundra, and a VW Touareg Hybrid. So those are over 6,000 pounds GVWR, gross vehicle weight rating. Okay, but remember, that's just the weight. For SUVs, definitely. For other trucks, I think also for vans and otherwise, a little bit, I'm not sure exactly how it works, okay, because the documents that I've read separate these out. Okay, so you get over 6,000 pounds, then you're like, okay, I'm gonna buy one of these vehicles. And you know that when you buy a vehicle, you don't necessarily have to put much money down at all. You could literally, potentially on an offer, get a vehicle for 0% down. Okay, so that's crazy. You can go in at 0% down, claim 100% business use of this vehicle, and Shazam, you take 100% tax deduction, okay, from the business. So I was like, okay, let's find out what's the most expensive car here. So Tesla X, okay, this is over 6,000 pound GVWR. It starts at like 80K, but if you max it out, and I maxed it out online, I did every option: Model X Performance, Ludicrous Mode, red multi-coat, 22-inch wheels, all black premium interior with carbon fiber decor, 6-seat interior, autopilot, full self-driving. Purchase price $124,490. Okay, and that's without paying sales tax. And then actually you have to add a destination dock fee. So this is going to be around $126,000, and that's not including cash tax. So let's just do $126,000, and let's pretend your sales tax is 6% times 1.06. That gets us $133,500. Now, if you're at the top tax bracket, okay, so there's $133,560. I was adding sales tax. I wasn't doing this before when I was calculating this, but if I multiply this by 0.37, so 37% tax, there's actually $49,417 in tax saved. It went up because I didn't add that tax before, but at $125,000, at the top tax bracket, you save about $46,000 in tax because of the $125,000 tax deduction. Okay, so this is crazy. You're taking a deduction for something you haven't paid for, right? That's how real estate works. These are paper losses. Now, you have to buy the vehicle, and it has to be used for more than 50% business use for every year you have it for like 6 years. But that first year you get it at 100%, then you just have to be like at 51% business use for the subsequent years because you've already depreciated the vehicle. And you need to keep records of all this stuff. But that's amazing, right? So you're taking a 37% tax, basically 37% off your vehicle. Now, what I really like about the change is not just the bonus depreciation, but it also allows you to buy used vehicles. Okay, because I've seen and heard about a lot of people who do like a 179, section 179 deduction before, and they would do that, and they do it on a new car. Because a lot of these rules require you to have a new car, but new cars depreciate super fast, right? So it's one thing to get a tax break, but if you're losing all this money to depreciation, it's like, meh, is it really that worth it? But now you can actually shop around for a good price. You don't necessarily want to overspend just because of the tax deduction. You can still get yourself a good deal or a cheaper price and claim a smaller tax deduction, but you're not going to lose as much money to the actual depreciation of the value of the asset. So for example, let's pretend you got a Tesla X that's 3 years old with 30,000 miles. And I don't know what's going for right now, but now that the Tesla Y is out, and with the Tesla Y6, the 3-row version coming out quite soon, I think the Tesla X is going to start getting a lot cheaper, especially the used vehicles. But let's pretend you can get a Tesla X for like $40,000. Okay, that's 3 years old. Like a base model Tesla X for like $40K. Well, now you actually have pretty good value there, because now you can bonus depreciate that full $40K. It's not as much tax savings, but you have a car that's not going to necessarily lose a lot of value. Tesla's maintained their value historically quite well, although like the Tesla 3 kind of undercuts the S, and the Tesla Y is undercutting the X. But if you have a 3, I mean, those cars are really holding on to their value very well. Okay, I did not see Kia Telluride on this list. That's like a mid-size, but that is a fan favorite. If Kia got a 6,000 GVWR Telluride, like a Telluride XL or something like that, that would be pretty awesome. But you could get, like, if you wanted to get an Escalade, now that could certainly get that'll get you 6,000, and those can retain value reasonably. But you could get one, a few years old at a reasonable price, and still claim a huge tax deduction. So there's a balance there. You don't want to overpay to get a tax deduction, because then you've just overpaid for something. But it opens the door for used vehicles, which really is a game changer. Now, there are some rules about that. And before you make a decision, I would definitely 100% check with your accountant what your plan is before you do this. But even if you bought a used vehicle, there are some exceptions. Like, I think if it was previously owned by a related party to your business, or if you somehow had used that vehicle, or there's like some exceptions. But in general, yeah, you can use it for used vehicles from what I've read, including from the IRS publication. So that is actually really, really cool. Now, if you're a 1099 contractor and you have a home office, I mean, that's awesome, because then all of your commutes theoretically could be utilized as business miles, assuming you work from home also, and that's your home office. For W-2 employees, not very useful, because you don't have a business to put this under. Okay, so you need to have a business where you have enough miles to utilize your vehicle as business percentage more than 50%. But hey, if you can do it, then that's awesome. Now, you do have to be a little bit careful about how much you do spend on this. Like, if you have a business that makes $20,000 a year and you buy a $125,000 Tesla, that's going to raise some big red flags. The IRS actually looks at the ratios of these losses to the income versus the claimed losses. So I don't think they say what proportion they want, but that's not going to really pass the muster. I mean, if you're making $100,000 and you're taking like a $30,000 loss, then it's a whole different story, right? But I would think your car value should probably be less than the total income. Now, if you have a business that generates taxable losses, that's a different story, right? Because then, like, if you own real estate and you're showing zero taxable income on your taxes, well, that's just the nature of being in real estate. But you still have cash coming in the door, and the IRS knows that. But yeah, if you have a real estate business and you use this car as your real estate vehicle, then it can make a lot of sense. Now, one of the key things about the bonus depreciation rule, which is the same as it is for real estate, is you can take that loss, and that loss actually goes, and it can take your taxable income sub-zero. Okay, it can go into the negative. Not that necessarily you want that to happen, but it can. This is slightly different from a Section 179, A Section 179 deduction caps you getting down to zero. So you want to be careful about how much you take, okay? Because you don't necessarily want to take 100% bonus depreciation if it goes to below zero and that below zero doesn't help you. Now, you can, from what I've read, choose to take 50% bonus depreciation instead of 100% if you'd like to. That way, you can decrease the amount of depreciation you take in that first year and save more depreciation for other years. Okay, and you don't have to take bonus depreciation. You can just do regular depreciation, straight line or modified, accelerated, the Mackers one, or you can just take the standard mileage deduction and do it by the mile. Okay, and alternatively, you can just lease a vehicle, and whatever the cost for that lease, 100% of that cost is deductible. The problem with leasing is it's only deductible in the year that you take that actual cost. So the beauty of bonus depreciation is you're depreciating the entire vehicle now before you've even paid for it. So it saves you a bunch of money in tax this year. You could save here $40,000 to $50,000 in tax. That's money that will come back to you when you file for your tax return, or it's just money that you don't have to pay them when you file for your taxes. Okay, and that's money in your pocket, which you can theoretically invest other places. And if you're going to buy that vehicle anyway, or lease that vehicle for a few years, then you may come out way ahead. Now, remember, when you depreciate something, when you sell that, you have a basis at the time you have it, and then when you sell it, there is a recapture of depreciation, a capital gains that has to be dealt with. And so you don't necessarily get it away from it 100%, but again, vehicles lose most of their value. They don't, within 3 years, usually lose about half their value. And the farther out you go, it loses more and more and more and more. Okay. And then there's also other things you can do with how you dispose of that vehicle so that you can minimize the amount of capital gains recapture you have to deal with after you've completely depreciated it down to zero. All right, and then at that point, you could, I think you could, like, for example, take it from the business and sell it to yourself for a small amount, and now you have the vehicle for personal use, and you paid a discounted price on it. But I think really the best value is taking something that's already depreciated a reasonable amount and taking bonus depreciation on that. Like if you're looking at a certified pre-owned vehicle, get a reasonably good price with a long like warranty, CPO warranty from the dealer. Like I remember we were looking at like a Volvo XC90. Now that one does not make the list, but when I was looking at Volvo's certified pre-owned policies, I was really impressed by their certification, like up to like 100,000 miles and 7 years or something really impressive, which actually made the value reasonable. And so you can take all those costs up front and you have something that's under warranty for a long time. So for like 6-7 more years, and you can depreciate that without having to worry about a lot of out-of-pocket expenses for repairs and whatnot because it's under warranty. Okay, but yeah, this is a pretty amazing thing that is available these days. From my understanding, I haven't done it. I technically, we do have a business we could put it under, but we don't really. It'd be hard to have it used for more than 50% business use. And at the moment, we have 3 cars and just 2 people, so we already have an extra vehicle. But this is something to strongly consider, especially because this 100% bonus depreciation rule, the same as it is in real estate, is not going to be here forever. It's in place for 2020, 2021, and 2022. So basically, you have 2 more years to do this after this year. And then in 2023 is when the rule starts to sunset. So instead of being 100% bonus depreciation, it'll be 80%. And the following year, it'll be 60%. So it will go down unless whoever's in charge redoes it. Now, one other thing to think about. And the Senate elections for Georgia are not going to be done before the end of this month, from my understanding. I think they're like in early January, or maybe at the very end of the month. I don't honestly know, but a lot is up in the air about what we think tax law wise will happen, depending if those two seats go blue versus not. Because if they both go blue, then it's blue in all three areas: House, Senate, White House, House of Representatives, and the Senate, all three arms, and much more likely that tax changes will go into effect. If the Senate takes one red seat in Georgia, then they will still have the majority there, and it's a lot less likely to go forward. And so this is all speculative, but my point is the top tax bracket right now is 37%, which historically is actually quite low. And then we also have these benefits and businesses with the qualified business income deduction, the Section 199. These right now are one of the lowest brackets we've had for a long time. It's not likely to gonna get any lower next year or in the next 4 years. Could it stay the same for the next 4 years or about the same? It's possible, especially if the Senate stays red. But if it doesn't, the likelihood of taxes going up, especially at the high brackets, very high. I mean, you can't just print how many is it? $3 billion? No, or $1 trillion? Unbelievable amounts of money, and then we have to pay it back, right? So someone's got to pay for it. So you may want to consider if you are going to do this, waiting until 2021. Okay, because if you're gonna save on taxes, you would want to save it at a higher tax bracket. But if you wait till January of 2021 to do this, then you're not going to see that money come back to you until like April of 2022. That's a long time to wait for your money. The beauty of doing this now is that you get your money back very soon. And to meet business percentage use near 100%, it's very easy if you don't own the car for very long of this year. You just keep it 100% business use until the new year. And it's a lot harder to do that if you buy a car early in the calendar year. Okay. There we go. That is it for saving a ton of money in tax buying a loaded Tesla X or other vehicle. This doesn't even count state tax rules. Okay, that's a whole different thing. Now, again, I am not a professional accountant at all. I read a bunch of articles, and different articles say different things. So not 100% of this is going to be accurate. Idea probably is. Please confirm with your CPA before making a decision like this. Not an accountant, not a financial advisor, not any legal or any other professional applicable to this. And this is strictly for my entertainment, hopefully yours. Until tomorrow, episode 141. Invite your friends to the Facebook group. Ask your questions over there. Good night.